On June 10th, the latest U.S. inflation report landed almost exactly where Wall Street expected. Headline CPI, the Consumer Price Index, was 4.2%. No surprise, no panic. But if inflation is still running above 4% and the labor market just doubled expectations, why are investors still pricing in rate cuts? That contradiction is now the most important question in financial markets, and the answer starts beneath the headline. At 8:30 a.m. Eastern on June 10th, the Bureau of Labor Statistics released the May inflation data. The headline Consumer Price Index rose 0.5% from the previous month and climbed 4.2% compared to a year earlier. Both figures matched the consensus forecasts tracked by Bloomberg, FactSet, and Reuters almost exactly. Energy prices stood out as the main force behind the monthly jump, with the energy index surging nearly 4% in May, more than 60% of the overall increase traced back to this single category. Gasoline and fuel costs, lifted by ongoing geopolitical tensions and higher crude oil prices, pushed household budgets higher across the country. Meanwhile, food prices edged up just 0.2%, and shelter costs added 0.3%, both contributing modestly compared to the energy spike. There was no sharp move in bond yields or equities at the open, signaling that investors had already priced in persistent, above-target inflation. The significance of this report lies not in its shock value, but in the fact that inflation remains stuck well above the Federal Reserve's 2% goal, keeping the debate over rate cuts very much alive. Core inflation offered a more nuanced picture beneath the surface of the May data. Stripped of food and energy, categories known for sharp swings, core CPI rose just 0.2% from April and 2.9% compared to a year ago. This measure, often favored by policymakers and market analysts, is designed to capture the underlying trend in prices that is less likely to be whipsawed by global oil shocks or a sudden change in grocery bills. For investors, the core reading is where the real debate begins. Shelter costs, which include rent and owner's equivalent rent, continued to press upward, adding to the persistence of core inflation. The shelter index rose 0.3% in May, and with housing making up roughly a third of the core basket, even small monthly changes have an outsized effect. Services spanning everything from medical care to transportation and personal care also remained sticky, rising modestly but steadily. By contrast, goods inflation played a diminished role, with declines in categories like household furnishings and new vehicles offsetting some of the upward pressure from services. The result is a core inflation rate that looks softer than the headline number suggests. Yet the question for markets is not just whether core inflation is easing, but whether that cooling is durable enough to matter for policy. As long as shelter and services remain stubborn, and with core still running nearly a full percentage point above the Federal Reserve's long-run objective, the case for immediate rate cuts remains far from clear. Investors are left parsing each month's core reading for signs that the underlying trend is finally bending toward the Federal Reserve's target, a process that rarely settles with a single report. Federal Reserve officials do not set policy by reacting to a single inflation print. Their long-run objective is clear: the 2% inflation rate, measured not by the Consumer Price Index, CPI, but by the Personal Consumption Expenditures Price Index, PCE. This distinction matters. PCE tends to run a few tenths of a percentage point lower than CPI, and it captures a broader range of consumer spending. In January 2026, the Federal Reserve reaffirmed its commitment to this 2% goal, emphasizing that decisions would be based on sustained, not temporary, progress toward price stability. Policymakers look for evidence that inflation is moving consistently toward the target, not just for a single month of softer data. The language in recent statements, sustained progress, and confidence that inflation is moving toward the 2% target reflects this approach. Even when a monthly report shows improvement, the Federal Reserve weighs whether the trend is durable enough to justify a change in policy. With core inflation still running above target and headline readings elevated, one constructive report is rarely enough to clear the threshold for rate cuts. The pace of convergence back toward 2% remains the central concern for the committee. Labor market data released on June 5th added another layer to the Federal Reserve's dilemma. Nonfarm payrolls rose by 172,000 in May, doubling the consensus forecast of 85,000 and nearly matching April's revised figure of 179,000. The unemployment rate held steady at 4.3%, showing little sign of slack emerging in the job market. Average hourly earnings increased 3.4% year over year, a modest slowdown from April's 3.6%, but still well above the level typically associated with subdued inflation. Gains were broad-based, with leisure and hospitality, local government, and healthcare leading the way. These sectors accounted for the majority of new jobs, reflecting ongoing demand for services and public employment. For policymakers, the strength of hiring complicates the case for near-term rate cuts. A labor market that continues to generate jobs at this pace does not create the kind of disinflationary pressure that would justify preemptive easing. Wage growth, while gradually cooling, remains elevated and feeds into services inflation, a key concern for the Federal Reserve. The combination of solid employment, steady wage gains, and persistent inflation above target leaves little room for the argument that the economy is at risk of stalling. Investors, too, are forced to weigh these dynamics. As long as payrolls remain robust and unemployment shows no meaningful rise, the narrative of imminent policy relief loses momentum. The labor market, rather than inflation itself, becomes the main factor delaying the shift toward lower rates. The Treasury market offered a clear verdict on the May inflation data: no sudden moves, no panic, and no sense of surprise. The yield on the 10-year Treasury note opened at 4.53%, and as the Consumer Price Index numbers landed, it barely budged, drifting in a narrow range between 4.53 and 4.54%. Trading volumes picked up briefly after the release, but price action remained contained, signaling that investors had already anticipated the outcome. For bond traders, this kind of muted response can be just as telling as a major repricing. It means that the inflation print, while above the Federal Reserve's target, landed precisely where consensus expected. Yet the fact that yields stayed elevated rather than falling reveals another layer. The market is not yet convinced that the case for easing is strong enough. Investors are holding out for more convincing evidence that inflation is cooling toward 2% before they are willing to bet on rate cuts. Until then, steady yields reflect a market still cautious, waiting for a clearer signal from the data. Investors do not trade on today's numbers alone. Every tick in the market reflects a running calculation about what comes next. That is why, even with inflation holding above the Federal Reserve's target and job growth running ahead of forecasts, rate cuts are delayed rather than dismissed. The underlying trend in core prices still shows signs of gradual cooling, and many expect disinflation to continue, though not in a straight line. This keeps the door open for eventual easing, even if the timeline keeps stretching further out. The labor market's resilience is the main reason markets have pushed back their bets on when the Fed will act. As long as payroll growth stays strong and unemployment remains low, policymakers feel less pressure to move quickly. Instead, investors shift their focus to the calendar. The next Federal Reserve meeting, new economic projections, and the updated dot plot will all test whether officials are growing more patient. Every new CPI release becomes a checkpoint, offering a fresh read on whether inflation is cooling fast enough. Labor market data, too, will be scrutinized for any sign that momentum is fading. Speeches from Federal Reserve officials and the release of meeting minutes will add further nuance, shaping the tone of policy expectations. Meanwhile, Treasury yields will serve as a real-time barometer of market conviction. If inflation moderates and job growth slows, yields could drift lower as the probability of a cut rises. If not, markets may continue to price higher for longer. The split in scenarios, faster cooling versus persistent inflation, drives the debate. For now, the path to rate cuts remains open, but the road is longer and less certain than many hoped at the start of the year. Today, headline inflation holds at 4.2%, while core inflation moderates and the labor market beats forecasts. For policymakers and investors, this tension keeps the path of rate cuts uncertain. Markets may hope for clarity, but the data leaves the debate wide open. What's your take? Share below. Headlines tell you what happened. Signals tell you what happens next.